events are unfolding pretty much as we anticipated, as I anticipated, as so many of the researchers that I follow have anticipated. So certainly need to be concerned about some things. So let's just go over these things. I deal with a lot of people with pension funds and retirement funds, and pretty sacred money. This is money at when you get to be my age, we can't necessarily get back. So let's just review a couple things. Here's what concerns me most. I've been talking about the risk that's in a stock market. Let me just go over this once again. It recently, and this was within the last 2 months, the Federal Reserve has said that they are no longer going to support the stock and bond market. They are going to remove their liquidity in the form of $10 billion a month. $10 billion, that's not a whole lot. It sounds like a lot of money, but in these big markets, not that much. $10 billion a month for the last quarter of 2017. That's this year. So that means that they're starting to remove their liquidity. It means that the stocks and the bonds that they bought, they're selling. Next year, they're raising up their removal to $510 billion. So at $510 billion, that means they're no longer supporting the markets. This has been the demand. It's every time that the market would get a little trouble, you'd see someone come in and buy the futures, the S&P futures and the S&P, and all of a sudden you'd have go from a bad day to a pretty good day. That's because the Federal Reserve's coming in buying stocks. I mean, how can you go 12 months in a row and not have 1 month that's gone down? So they've stopped. Also, all the central banks of the world have said that they're going from $2 trillion. Yes, that's 2 trillion with the T dollars, that they're no longer going to support the markets. So by April of 2018, they're going to go from 2 trillion to zero. Get that? 2 trillion to zero. That means that they're no longer going to be buying bonds and they're going to be buying stocks. So listen, if the banks in Germany say, look, we want to sell you these bonds at 0%, they've said, oh, sure, we'll take those. The Bank of Japan has said that, when corporate bonds come in, we'll buy them. The government bonds, we'll buy them. The Spanish bonds, we'll buy them. They're buying all the bank bonds. They're buying all the corporate bonds. They're buying everything. Oh, sure. 0%, sure. Negative interest, sure. No problem. We'll buy them all. So all of a sudden now, let's see, a municipality in Germany want to sell them bonds. Now they're saying, sorry, we're not buying anymore. Well, what are they going to do with this 0% bond? Well, you can't price it at zero anymore, because who's going to want something for 0% when you have no government interference? So you're actually going to have price discovery. Guess what's going to happen to the bonds? This isn't rocket science. When the central banks of the world quit buying all the bonds, interest rates are going to go up. They're actually going to have to charge something for use of the money. Same with the stocks. So we've been saying that this is going to come to an end. It's coming to an end. So if you know these things, if you know that the stock and the bond market are no longer going to be supported by the central banks of the world, how can you have your money sitting in the stock and the bond market? You've had a phenomenal marketplace. You made 2, 3, 4 times on your money. It's time to take a profit. Do you know that 70% of the wealth for retirees is in the stock market? Lose 40%, and how wealthy do you think you feel? Same with the bond market. So if the stock market is no longer going to be supported by the QEs from the central banks, it's time to get out. Do you know that the Swiss National Bank, the Central Bank of Switzerland, owns more stock in Apple than any other individual, any other entity? It's owned by the Swiss. They just push a button, create this money, and they buy stock in Apple. So it's not going to happen anymore. So look, you have 4 asset classes that you can put your money. You can put it in stocks, you can put it in bonds, you can put it in commodities and precious metals, you can put it into real estate. The commodities are coming to the end of their cycle. They're finally starting to pick up. They've been creamed. I mean, iron ore has dropped 80-90%. Copper is just starting to rise a little bit. Gold was at $1,900. It's $1,200-$1,300. It's been going back and forth. They bottomed, but they're not going up, and they give you no income. So let me make a suggestion. This is a little self-serving, so I'm sorry to do this, but it's really, really good advice. So if we have the commodities that are starting to come up, which their cycle is starting to come up, that means that copper and aluminum and lumber and iron ore and aluminum are all going to eventually start to rise because their cycle is coming. That's what we build single-family homes out of. We build single-family homes out of all these basic materials. So why don't you buy a single-family home and get some income coming off it? You still be able to participate in a different asset class because they're on a different cycle than the stocks and bonds. And you'll be able to participate in a cycle that's still, the real estate cycle has still got 7 or 8 years to run on it. And you'll be able to participate a little bit in commodities. So that's an idea for you. You can get yourself some income coming in off of Brent because it has a use factor, so you can use that. So let me tell you, do you remember 2008, 2009, how tough that was? That's because the stock market and the real estate market, the two cycles ended within like 5 or 6 months of each other. It was a really, really difficult time. 2 of the 4 cycles came to an end. Pretty tough. One of the cycles is only like 9%, 10% of the total. So now you have the stock market and the bond market. Both of them are coming to a cycle. You're going to see that the stock market drops and the bond market's not going up. The credit markets are deteriorating. That's because both of them are coming together. You are going to have a crisis in bonds as well. Not only are you going to have interest rates coming up because there's going to be actually price discovery that we haven't had for years and years and years, but you're going to have debt. Look at you. The president of the United States goes to Puerto Rico. He looks at their bond portfolio and goes, and he's a businessman. He says, this has to be liquidated. You know why he says that? Because there's no way it can be paid. No way it can be paid. So you have places like Puerto Rico and the state of Illinois and the state of California and some of the other states in the United States. Now you've got Venezuela I think it's officially in default as of today. And you have Germany. I'm told that 50% of the municipalities in Germany are struggling to pay their rents or pay their bond interest. Now keep in mind their bond interest is close to zero. So all you have to pay back is something that's like 0.25%. Just think how easy it is. It's cheap. And they're struggling now. What happens when interest rates come up 1%? Just 1%. And to normalize, it would really have to come up 4 or 5% in which to normalize. So, the U.S. Treasury Department is paying over $500 billion a year in interest payments. And we're under 3%. The total of the interest payments is less than 3%. I think it's like 2.25 or 2.35, something like that, because like 70% of the debt is in less than a year's maturity, and of course that's like 1%, 1 or 2%. So you realize that when you're talking about the budget of $500 billion in interest, Medicare, which is one of the largest line items in the U.S. budget, is like $665 billion. So let's just raise it $1 billion. And our debt is going to be more onerous than Medicare. And that's only coming up 1%. What happens to our debt at $20 trillion when all of a sudden you're at 5%? When you double, we'll be having $1 trillion, $1.5 trillion, $2 trillion just in interest repayment. Things are going to get very, very interesting very, very quickly. So listen, if you're in stocks and bonds, please, please, please talk to your advisors, talk to your spouse, talk to your significant other, talk to your financial advisors and say, play the what if game. What if the stock market really starts to have trouble? What if the bond market starts to have trouble? What are we going to do? And just do that. What are you going to do? My suggestion to you is to take half of it off the market, maybe more. And we have here in Maricopa County. I'm really, really fortunate. I live in Scottsdale. It's in Maricopa County, #1 market in the country. So we have 222 people a day coming here. It really puts pressure on a rental. So our rental market here is just awesome. So we've been able to maintain our rents, and actually they've been increasing really, really nicely. So we have cash flow in our properties, really nice cash flow. Let me tell you what cash flow does for you. If the market starts to disintegrate, the stock market goes down and bond market starts having trouble, the general economy is going to have trouble. But we have cash flow. our properties are actually paying us. We're actually getting a nice dividend off them, and we're doing really, really well off these things. So I'm going to tell you is if you should really consider just rearranging your portfolio. Rearrange it from stocks and bonds. Take some of your profits. Just take your profits and rearrange it to a different asset class. We're here in Maricopa County. We actually have really good properties that are going to grow like mad. And should we get into some kind of a economic downturn, which a lot of people are thinking we may just have coming this way, if it does actually downturn, we're going to have cash flow to mitigate any problems. Because in my business, we're economically sensitive. So if the economy goes down and you're used to making $100,000 a year, and all of a sudden you're only making $60,000 a year, well, you have a $40,000 deficit. So we have properties that make up that $40,000 deficit, more than that. So that's what we'd like you to do, is to get yourself a little cushion. I called a lifeboat, and it's your core holdings. It's a lifeboat, and this just keeps on cash flowing because people need a place to live. And the last thing that they're not going to pay, I'm going to tell you, is the roof over their heads. If you have children and need some place to sleep at night, so they certainly want to pay their rent. So that's what I'm going to advocate for you. It sounds self-serving, and yes, it is self-serving. I'm sorry. It just makes such good investment. It's just so good advice at this point. I mean, just get out of an aging market and get into something that's nowhere near its peak. So my very, very best to you all. Call me if you need me. Bye-bye now.